I see. So there are really factors that are outside the company's control. So, if there is, if there are factors that a company cannot control, I believe its opposite exists for most businesses. Miss Clarice, how about those factors that a company can control, and what are they? Oh, I see. So there are really factors that are outside the company's control. So, if there is, if there are factors that a company cannot control, I believe its opposite exists for most businesses. Miss Clarice, how about those factors that a company can control, and what are they? Can you explain us?
Yes. So now we will discuss the factors that companies can control. And this includes first is their intangible assets. So these are the assets that has no physical form, such as their trademarks, brand names, goodwill, copyright, and the such. Since it is their assets, they have all the right and all the power to control it. Their performance would definitely reflect onto this. Also, the business model of the company. This is how their operations and strategies are designed for the benefit of the company. One can adjust this based on their needs and also build a good one that is fit for the company. Next is the competitive advantage. This is the edge of the company, the winning cards that will rise them to the top from their competitors. And of course, this will be earned through good management and effective strategies. And we have management and good governance. Now, this may sound the same, but they are not. Management is how executives grow the company by taking advantage of their business model, whereas good governance is how executives protect its company's reputation and the company itself. Transparency is also included in these factors. Honesty and openness is a really important thing to have. It can be the reason for gaining trust, and also when it comes to handling operations, problem can be easily discussed since it is communicated honestly to everybody. With this, they could come up with an effective solution. Last on the list is the structure of the board of director. Now, they are an important element of the company because they contribute a lot in the decision making phase as they link the shareholders and the management for this. Now, compared to the value investors that believe that purchasing securities should be justified by the overall economy and the issuing firm, growth investors differ from them because growth investors pursue steadily growing companies that have overcome decline stages. They do not really consider the purchase price that much as long as the performance of such shares is above average. They focus more on capital appreciation. That is all.
Mm-hmm. Bit by bit, I now understand. So the value investors, they look at macroeconomic information, while the growth investors, they don't really care that much about the price as long as the performance of shares is above average. So for we are now that down to the last topic. Um, this will be at least the last. Um, for Miss Cassie, as we went on the as we went on with this matter, I see there are ratios included, and so it must be understood further. Miss Cassie, how many are they, and how they are being used, and why they are to be considered in stock market?
Well, there are four fundamental stock analysis ratio. The first is the earnings per share ratio, the price earnings ratio, the book value per share, and lastly is the price to book ratio. So when we say earnings per share ratio, it is a company's net profit divided by the number of shares outstanding. It indicates how much money a company makes for each share of its stock and is a widely used metric to estimate corporate value. A higher EPS indicates greater value because investors will pay more for a company's shares if they think the company has higher profits relative to its share price. EPS can be arrived at in several forms, such as excluding extraordinary items or discontinued operations or on a diluted basis. The earnings per share value is calculated as the net income, also known as profits or earnings, divided by the available shares. A more refined calculation adjusts the numerator and denominator for shares that could be created through options, convertible debt, or warrants. The numerator of the equation is also more relevant if it is adjusted for continuing operations. So EPS is equal to net income minus preferred shares dividend over outstanding common share. To calculate a company's EPS, the balance sheet and income statement are used to find a period-end number of common shares, dividends paid on preferred stock, if any, and net income or earnings. It is more accurate to use a weighted average number of common shares over the reporting term because the number of shares can change over time. Then the next is the price-earnings ratio. It relates to a company's share price to its earning per share. A high price-earnings ratio could mean that a company's stock is overvalued, or else that investors are expecting high growth rates in the future. Companies that have no earnings or that are losing money do not have a price-earning ratio since there is nothing to put in the denominator. Analysts and investors review a company's price-earnings ratio when they determine if the share price accurately represents the projected earnings per share. The formula and calculation that is used for the price-earnings ratio is equal to market price over the earnings per share. To determine the price-earning value, one simply must divide the current stock price by the earnings per share or the EPS. The current stock price can be gleaned by plugging a stock ticker symbol into any finance website. And although this concrete value reflects what investor must currently pay for a stock, the EPS is a slightly more nebulous figure. The third one is the book value per share or the BVPS. It takes the ratio of a firm's common equity divided by its number of shares outstanding. Book value of equity per share effectively indicates a firm's net asset value, total assets minus total liabilities, on a per share basis. When a stock is undervalued, it will have a higher book value per share in relation to its current stock price in the market. The measure is used mainly by stock investors to evaluate a company's stock price. The equation for this is equal to BPS is equal to shareholders' equity over the number of outstanding shares. The book value of equity per share or the BVPS metric can be used by investors to gauge whether a stock price is undervalued by comparing it to the firm's market value per share. If a company's BVPS is higher than its market value per share, its current stock price, then the stock is considered undervalued. If the firm's BVPS increases, the stock should be perceived as more valuable, and the stock price should increase. Lastly is the price-to-book ratio. It measures the market's valuation of a company relative to its the last fundamental stock analysis ratio is the price-to-book ratio. It measures the market's valuation of a company relative to its book value. The market value of equity is typically higher than the book value of a company. It is used by value investors to identify potential investments. Under one are typically considered investments in these price to book ratios. Companies use the price to book ratio to compare a firm's market capitalization to its book value. It's calculated by dividing the company's stock price per share by its book value per share, or the BVPS. An asset's book value is equal to its carrying value on the balance sheet, and the companies calculate it netting the asset against its accumulated depreciation. Book value is also the tangible net asset value of a company calculated as total assets minus intangible assets. Example for that are patents and goodwill and liabilities. For the initial outlay of an investment, book value may be net or gross of expenses, such as trading costs, sales, taxes, and service charges. Some people may know this ratio by its less common name, the price-equity ratio. In this equation, book value per share is calculated as not total assets minus total liabilities divided by the number of shares outstanding. Market value per share is obtained by simply looking at the share price quote in the market. The formula for the price to book ratio is equal to market price divided by the book value per share. A lower price to book ratio could mean that the stock is undervalued. However, it could also mean something is fundamentally wrong with the company. As with most ratios, this varies by industry. The price to book ratio also indicates whether you're paying too much for what would remain if the company went bankrupt immediately. So that's it.
Thank you for that, Miss Cassie. Though investment is risky in its entirety, the computations given will serve as the guide for allocations and also the basis on how and where to invest. I think that's it for today, and thank you for joining us here. Thank you for Miss Maydell, Miss Clarice, Miss Cassie, Miss Lillian for being with us and for this interview. Again, I'm Crystal Jane Barreros, saying there's always room for improvement. It's not too late to learn. Thank you and goodbye. Keep safe.